I always have to remember that it's 2 clicks to make go live. So, good afternoon. Welcome to the Business Broadcast. You are such lucky people having 2 in 1 week with our special from yesterday. Anyway, today we are rejoined by a popular speaker, Peter Felix. Hi, Pete. How are you?
I'm good, Nikki. Good to be back. And so I missed the one yesterday. I was at presentations all day, but I'm sure it was a success as always.
Well, it was just an emergency special so that people know the reaction and what business owners should be thinking about from the autumn statement yesterday. So that's all on LinkedIn. You can and just catch up whenever. Well, just a short little 20 minutes it was. Okay, so today what we're doing is a little bit. It's a little bit niche because it depends. It's not going to be relevant to all businesses. However, a lot of businesses do import goods. So what we're doing today is going to be discussing the financial risks of that activity and how to try and mitigate those financial risks. So hopefully we'll come up with some things that you might not have thought about before, and just try and make it as a much easier, some tricks and tips of the trade. So thank you, and as always, please do say hi, and do ask us questions as we go along. I know Pete and I, we look so young, but between us, we've got about 60 odd years of financial experience. So we should be able to answer just about anything you want to throw at us. So, and if we don't, we will know a man or woman that can. So, right. So let's just sort of start at the beginning, Pete. We particularly want to talk about today. One, there's lots of different changes. Obviously, there's due to COVID, the pandemic, due to Brexit. The landscape has changed, good or bad. It's changed, hasn't it? So tell me now, from what you're seeing, what your clients are saying, what are the trading conditions for the businesses at the moment that are importing? What are you seeing?
For most of our clients are all saying very much the same thing, that the whole trading landscape is different, particularly for those bringing in goods into the UK. You've got to think about the fact that we're not a manufacturer of anything that we sell. Principally, that's all imported. I've got people who are saying to me that they're having price rises enforced on them, not once a year, but maybe several times in a quarter. And it's very difficult to try and manage your margin and be in a position to make a profit, particularly where you can't pass those costs directly onto your end customer, because they can only absorb so much. There seems to be a scarcity of supply as well. The supply chain seems to be broken, and the supplier, particularly what will be the exporter to our importer, seems to have got the upper hand now, and it's he who has the cash gets the goods, and he who is most organized and understand particularly the changes around dealing with the EU now is able to bring the goods in. We've got situations where there is the level of competition for those goods is high. So larger companies often traditionally use the SME to bring in the goods for them, because why would they want to take the import risk? It's an absolute nightmare. You just sacrifice your margin and let the little guy do it, because he's far more maneuverable than a large company. If you're sitting as a CEO of a multiple retailer and you're bringing in your Christmas stock, you let a small SME do it, because they're going to be dealing with the Chinese exporter. They're going to be dealing with the payment difficulties. They'll be taking the shipping risk, the insurance risk, and as you as a CEO of a multiple retailer, the goods just appear on your shelf as if by magic. And all the Forex difficulties, the language difficulties, the documentations, all been done for you by the SME. So that's causing a lot of problems. Where the margin used to be good, it was worthwhile a lot of businesses getting involved in that. But we're seeing a lot of company failures. We're seeing the banks being very, very reluctant to fund, because the available security for them just isn't there anymore. And particularly, if you're a clearing bank, why would you want to fund a business where the margin is heading south and you've got no payment capacity? So that's what I'm seeing.
Okay, so not a lot of joy in
No,
there,
yeah,
unfortunately. No. But that's why we're here, to try and help mitigate and try and navigate people through these SME owners through these challenges. So let's talk about import finance risks.
Mm-hmm.
So this is going to be another list of things, but not great things. But this is important if you're an SME that's going to be importing. You need to have your eyes wide open and understand the risks. So, what are the finance risks that you can have when you're importing, Pete?
Well, I think for a lot of importers, the most important thing is go back to managing one's margins, is understanding currency fluctuations, because your margin obviously depends on the exchange rate you agree at the time and whether you can lock that rate in. And we are seeing a lot of SMEs who are coming to us for advice on that, particularly with the products that we sell. And we're able to refer them on to Forex traders who can lock in that margin for them. But there are some who still take the risk. And it's to us, it's like playing Russian roulette with 6 bullets in the barrel. You're going to get shot. But it's much better to sacrifice a little bit of your margin to guarantee at least you're going to get the vast majority of it. The other thing I think is that a lot of people underestimate the amount of cash they need to bring goods in. They really do. Because getting back to scarcity of supply, if you're a supplier and you've got several routes you can put your goods out to, you're able to demand 30% deposit before you start to make the goods. If you're a manufacturer, or if you're a reseller, you want 30% up front before you pack it. And most of the time, particularly if you're dealing with China, India, or any other Far Eastern suppliers, they'll want the 70% at the point of shipment. So a lot of SMEs need to understand the Incoterms in which they're bringing the goods in, because that will have a dramatic effect on their cash. So often they'll try to mitigate that by going to their banks. The banks are a cheap source of funding, and the idea being they can obtain a letter of credit or an import loan only to be turned down. So they've got a purchase order from an undoubted debtor. They've got a supplier who they've vetted, and the bank may have vetted the supplier, and the supplier goes through really good quality control, but they lack the funds to bring the goods in. So they've not only got the Forex risk to consider and mitigate against, the raising of the capital, and even worse, if they get all of that sorted and they're bringing in goods to sell to a multiple or a large customer, they have got the 60 to 90 days wait to be paid. So often what they don't consider is that from day one of placing an order with a foreign supplier to bringing the goods in and getting paid could be a transaction time span of up to 180 days. That's a lot of risk to manage.
Yeah.
So there are solutions, which I know we're going to talk about, how they can mitigate against that and circumnavigate these issues. But a lot of people need to go into this with their eyes wide open. And you do need cash. Cash is king, particularly now at the moment. And I read somewhere today that the average, that 1 in 5 SMEs have only got sufficient cash reserves for 2 months of trading. So that's the maximum they can tolerate their debtors not paying. And that's a frightening statistic.
Yeah.
And I suspect a lot of that is because of the problems we've had over the last couple of quarters. Probably wasn't like that in 2021. But
it's all depleting. And especially, like you said, from these sort of SMEs, they're being pinched in 2 ways. One, they're being asked to be paid up front. So that's obviously depleting their reserves. And second, the lead times now are so long, whereas they might, if they're having to buy something, but then they're not going to be able to sell it for 6, 7, 8 months and therefore not receive their money for a long time, that's a huge amount of time their working capital is tied up.
Agreed, 100%.
So it's a massively different proposition. It's a completely different business from a working capital perspective than it was, just 3 years ago, when most businesses were still running on, just in time models, weren't they?
Yeah, that's broken down now.
Yeah, you just can't risk being just in time anymore, because not, as you said, like there's lots of resource shortages. So, in a lot of areas, it's like aluminium, it's been huge. That's why, there's been like 80-90% increase, massive shortages. Obviously, the construction, there was it wasn't that long ago, a lot of building people were talking about plasterboard. There was a huge shortage of just plasterboard, and you would think, what? How can you be
concrete?
Concrete
as well. Concrete was one. Just have to look at the car industry. There's a massive shortage of transistors, so hence the long lead times in ordering the vehicle.
Absolutely. I was just talking to one of my Twitter friends yesterday about, she was complaining it's her lead time for ordering her car was like 18 months, which is crazy, and that was potentially being delayed even further. So, this is it's a big change. Obviously, people that used to work in procurement now sort of more in the 80s, 90s, they sort of understand this sort of bit more. But those that are more modern, younger, they've only experienced just in time. This is a massive difference and change, and it's a lot of burden on the SME. So
skill sets are now required now.
Absolutely. So you're talking about security, you mentioned.
Yes.
So for SMEs, what security can you just go through a bit more detail? What options does an SME have for security?
Okay, and well, essentially it all boils down to the fact that an SME needs cash, and the source of cash either comes from a bank, which is the primary source of cash, or it goes down to alternative funders like myself. But let's just take the bank off. So the security requirements are slightly similar, but not as stringent as a bank would be. So a bank will typically ask for a personal guarantee, which in most cases will probably have to be asset backed. So you need to have, being a homeowner these days isn't the same as being a homeowner as it was before high house pricing. So someone may come to you and say they're a homeowner. Yes, you are, but you've got a 95% mortgage against your property. So technically, you've got no equity. By the time that you margin down for cost of repossession and cost of sale and disposal, there's no assets. There's nothing. So they're technically secured. So that's a non-starter for a bank. Company, generally speaking, try to make the whole thing transactional by having a letter of credit, import loan, and then hopefully by that time the debtor pays and the import loan is then repaid, which frees up the availability for another letter of credit. But if you haven't
So just for those out there, just explain what is a letter of credit.
Of course, a letter of credit is an irrevocable guarantee from a bank to another bank, guaranteeing that if I was the importer, that I am good to the value of X. So it means that if I fail to pay, the bank is guaranteed that payment. So for loss of foreign exporters, that's money in the bank, because often for a lot of suppliers in the Far East, they'll take that document and they'll raise cash against it in their own domestic countries as well. So it's a guarantee from a bank. An import loan is when the letter of credit has a expiry date. So when that expiry date is reached, the banks will then convert it to an import loan, which then amortizes on bullet payment from the debtors when the money comes in. So it's a structured approach to doing things. The risk for the bank is substantial, hence the reason to have fallback security from the guarantor. Now, the SME may feel that because they've got a purchase order from a well-known well-known customer, that is not a guarantee of payment. The fact is that debt will be linked to some form of, there'll be some contractual terms as to why they can't get it, why payment may not be received. So failing to achieve all of that, it means that the bank, the SME has to look at other ways of funding it. And that is looking maybe at the trade finance model, where the trade finance company takes a interest in the debt, in the actual stock, and has instruments in place which control the stock and allow funds to be released, subject to the business being able to achieve a certain margin. It's very expensive funding, but it's substantially less than the opportunity cost of not having the cash. And that is the way in which many SMEs have to go, because they haven't got the security to get the cheaper pricing from the bank. The bank is not in the business of taking risk. They then have to go to a trade finance company, which may be borrowing the money from a bank at a cost. Therefore, they need to sell it to the SME at their cost plus their margin to allow them to make a return, which means the SME is sacrificing margin to bring the goods in. But ultimately, there should be a win-win at that point. So they can either use this, they can either use the personal security and raise money from a bank, or they can use the stock via trade finance facility and the PG that probably is not worth the paper it's written on because they haven't got the equity. But by signing the document, at least the trade finance house is probably thinking, you know what, they've got some skin in the game here, so I'm going to help and I'm going to fund them. So it gives them that ability to trade through. Those who haven't got a very good transaction won't get funded.
So that which neatly goes into our next section. So what options are there for financing for an SME?
Okay. So again, as with any business, your first protocol will always be to your bank, because obviously that's where your costs are lower. And the good thing I like about this forum is that we are transparent and we direct people to the right sources. So if you know that you have not got equity in your property, you have not got any other vesting security, just do not waste yours or the bank's time. Once your time's gone, you can't get it back. And it could take up to 6 to 8 weeks for a bank to say no, because by the time they do their due diligence. So your best advice would be to look at, say, your professional business advisor. So it could be your accountant, it could be your broker, who will have, like, for example, take yourself, Nikki, you've got a panel of lenders and you'll know instantly based on what your client tells you where you can post that client. So let's call them the key business influencer, will say, right, you've got a great confirmed purchase order. There's 2 ways you can go. You're profitable. You can go exclusively to a trade finance house. There might be a little chink in your armor here. So I think we're probably going to have to put you with a business that not only finances the import of the stock for you, but will take a residual interest in the trade receivable at the end and repay the stock finance from the invoice finance, because you're not strong enough to be able to pay it back yourself from your own resources. So what we're doing in that instance is transferring the risk from the client, which is the importer, to the debtor, who might be a undoubted blue chip debtor. Let's just say the largest retailer in the UK. We know who that is. If it's against that sort of debtor, it's undoubted, because they sit in the category of won't pay as opposed to can't pay. The won't pay is they won't pay to your terms ever.
No.
And can't pay.
I went for yesterday. It was like chasing money. It was like, no, we only pay in 60 days. And you're like, that's not what it says in our contract, but they've got, they've
got power.
They just have to wait.
I've got a friend who's a buyer for multiple retailer, and his view is if they don't like it, they're going to take the stock back. So most people aren't going to do that. So it's that option. But what you got to look at is what the SME's got to look at is that his customer at the ultimate end of it is also sacrificing margin, because they could go directly to China and bring the goods in themselves, but they don't want the hassle that we've just talked about. So they give it to the SME. So it may be that they could have probably got an extra 10%, 12% margin themselves, but they give that to the SME and said, there's your margin, that's your bit, you play with that. So the SME is going to work out, do I then give another 2% away to my funder? And the answer is absolutely yes. Because if you're going to get 10% back for yourself, or sometimes we exist for the margins a lot higher than that, but I'm just playing with numbers. But the opportunity cost of not having the cash to bring in the goods and make a margin anyway, you're not going to be able to fulfill that order with your ultimate debtor at the end. So it's balancing those risks. So balancing by getting the funding, getting the right currency hedging tools in place so that your margin's locked in, understanding the documentations and the countries, the regulations that are required to deal with that customer, and understanding that the supplier abroad, it's nothing personal, that they're not prepared to give you any credit. It's nothing personal. They want to be paid. So they want 30, 70%. And fully understand your Incoterms. If you don't understand your Incoterms, you're in serious trouble. And because luckily, if you are going through...
So like you said, sorry, it's a bit, I was just going to say, like you said, really, you really need to understand your pricing model, and all of these things are factored in to make sure that this deal is worthwhile and will end up making you money. You've got to be very, very careful and make sure you really understand all the parts.
And that's why...
And stress test it. You know, what happens if that gets stuck in a port for an extra 2 months? You know, is that what's it going to do to your business?
Well, let's look at it. Yesterday, the dollar was 118 against the pound. I remember going to America when the dollar was as high as over 160, then it was 150, then went down to 140, then it went down to 130, and it's now 118. Now, bearing in mind, when we were hoping it's going to get to a point where it's going to be almost 50% cheaper, we all flooded to New York, didn't we? And we bought as much as we could. Could you imagine then, now, it being 118? I couldn't. So it just shows, it gets back to your point, being able to lock in that and be able to anticipate.
New York shopping.
Yeah. So I
put you off from doing your New York shopping trips. Oh, sorry. We seem to have a bit of a delay. Sorry, Pete. Just so obviously continue with your point, but just in case it's not syncing for some reason, it's a bit of a delay to whichever part of Reading you're in today. How can you safeguard the funds as well?
In terms of safeguard funds, generally speaking, from our perspective, you mean from the client's perspective or our perspective? Clients.
From the SME. The SME, okay. That's who I care about.
Okay, the SME.
You can take the bit.
Yeah, the SME, in all the words, to safeguard the funds, is if you're using a bank or you're using a specialist trade funder, they would have done the DD on the supplier. They wouldn't just allow you to have their money without asking questions about your supplier. They'll need to see that your supplier has done that particular trade before with you. So a new start importer dealing with a supplier for the first time would struggle to get cash from any lender. They would absolutely struggle because there's no track record. Banks and lenders lend on the basis of track record. So someone new into the market is going to struggle. They're going to struggle big time. The bank will want to see them put their cash in first and do a few trades before they put their cash in. So by part of the DD... Is
there any like insurance or anything like that on this? Is there any type of
there's various there's goods in transit insurance you can get. The part of our DD, when we're looking at an SME, we would look at the supplier, we'd look at the QC policy that they have, who's doing the QC, do we know them? The goods will need to be insured anyway. We check the insurance, we need all those documentation before we would release a single penny, and to The supplier, the importer may want to take out bad debt insurance on his debtor when the goods get here, because the risk aren't only just bringing the goods in, the risk is also if the debtor's going to pay him or not, because he's incurred cost but he hasn't seen a single penny back until the debtor pays. If it's on the basis of borrowed money, the actual redemption is all based around the debtor paying. That's when all the costs are redeemed. So you can have insurance making sure goods in transit are there. The end debtor is insured, and he's working very, very closely with his lender on what we refer to as transaction matrix, making sure that everything is sequential and works in the way which ultimately leads to the debt being paid. So these things are fairly structured. So the guys I feel sorry for is the guys who may have a great idea, but they've never done it before, because no one's going to jump in and help them. It's going to be typical. It's chicken and egg for them, because without the money, they can't do it. Without them doing it, we can't lend them the money.
The other thing to think about, and it's difficult when you're a very small SME if it's not a big enough amount, but this is something that, you know, I dealt with when I was in corporate. And if, you know, you do have to look at the exchange rate risk.
Yes.
So if you can hedge the exchange rate, that makes sense, because otherwise you might end up that deal that looked very good when it was 130 on the dollar, and then by the time the deal goes to it's at 120,
you've made losses.
It's dead. Yeah,
you've made losses.
So
we see that all the time. It's one of the things we look for when we're looking at companies which are importing. We look to see if there's any exceptional items in their P&L account, particularly around Forex risk and Forex adjustments in their P&L account. And if we do ask the question, and normally would direct them back to their advisors to be introduced to an FX brokerage to get that risk mitigated, because people may not see, but when you think about the movement that you've just described there from 130 to 118 or even 120, that's massive. It's huge.
If you're talking about, you know, a 7% margin on certain things, you know, if it's just, you know, your hardware provider that's got very narrow margins,
yes, of course,
you know, that just takes away all the margins. So got to be very, very careful. So as always, please do contact Pete direct on LinkedIn. He's very happy to answer any questions, have a coffee, discuss options. Just one thing, so if somebody's got a deal coming up, so, you know, some SMEs, you know, especially now, just do think about, well, actually, you know, for their peak seasons, like I had a importer that would import paving slabs from India, for example. They probably only did it a few times a year. They don't do it every month. You know, when do they need to, if they're thinking of, right, I'm going to do a big import in February, say, when's the time to start talking to someone like you?
I'd say now, because the most important thing
November is talking about a February deal.
Yeah, now, because all the nuances of the deal could be ironed out, all the questions, all the contracts can be read. It means that the bank's not rushing. If a financial organization is being rushed, it's easier for them to say no. If they're given time to look through the deal and to come back with any queries or concerns, or to structure the deal properly, time is vital, because ultimately all that will happen at this stage is an offer will be made. So that the client has an offer. It's not a formal contract and no consideration has taken place. There's nothing's been discharged, but at least they've got an offer and they know that they can actually trade with confidence. And that's the key. And if the offer's valid for 90 days for most lenders, it normally means a refresh with credit, which typically means just a refresh of the financials. Or and also a resubmission of the age debtors, age creditors, to make sure that nothing adverse has happened to that business since you last spoke to them.
And absolutely, and for any type of finance, if you're trying to rush it through, that's when you get the worst deals. So do try and do it as soon as possible. You know, as soon as you know that you've got a big import deal happening, or even potentially happening, you know, start getting that lined up now. Our lovely Paul, he's gonna make us feel young now. So I pay a lot of attention to exchange rates, but I must say, when I was 5 at primary school, I wasn't paying attention to exchange rates. So 235. Those were the good old days.
I was 11 then.
You were 11. I was 5. I probably didn't know this. Everyone exchange rate was then.
It puts it in perspective now, doesn't it? It's like
235. But you know, the 70s, that was at 4-day weeks.
Yeah, hyperinflation.
Blackouts.
Yes.
Oh, that sounds a bit familiar to now.
It's all coming back, isn't
it? We're all going to be in flares.
Yes. Yeah. And platforms. Don't forget the platforms to stop the flares from getting dirty.
Yeah, and orange and brown shirts.
Yeah, I think didn't they say the 70s, the decade that fashion forgot?
Yeah, indeed. I don't want to look at any of my young videos.
You know, those things are worth quite a lot of money now. They're worth quite a lot of money. So if you've got a pair of flares, you're sitting on a gold mine there.
They all went to jumble sales.
Oh, there you go. Someone else has made a fortune.
I don't think you have jumble sales anymore. It's
vintage now, or other things like that does it. Yes.
Anyway, that was super useful. Thank you so much, Pete. So anything about import financing, Pete is your man. Have a chat with him. He has decades and decades of experience and can definitely help him guide you through the process. Anyway, any fun things for the weekend, Pete, apart from getting your flares out?
Actually, I'm going to a jazz concert at the Institute of Directors tomorrow at 1:16 p.m. Should be good. It's quite a novel thing, really. Sort of afternoon tea with a live jazz band. Don't know how that's going to work. And Sunday,
that'd be amazing. I love listening to jazz. Brilliant.
So I'm looking forward to that. And Sunday is the finals of my salsa dance competition with my better half. So we're in the finals tomorrow. So
we need pictures. We need pictures and videos.
I know. So if I don't win this, I'm dead. So what about you? What have you got?
Twinkle toe. I've done my usual thing. The week's just flown by and I haven't even thought about it yet.
Wow.
To be honest, hopefully we'll do some sort of nice trip. We had a bit of a failure last week. We tried to go and see the Downton Abbey because, as you know, it's just up.
Oh yes.
It's all locked up at this time of year, so we need to find somewhere else interesting to go and see tomorrow.
Is that National Trust building?
No, it's privately owned, but they do open it up to the public. But I think you have to book in advance and stuff.
Okay.
And they don't tend to open in the winter. But we were hoping to see a peak of it. But
yeah, of course. In fact, my National Trust card just arrived yesterday. Actually,
I need to renew mine.
Yeah, so I need to put the sticker in the car. I keep forgetting to do that as well. Yeah, so arrived yesterday. You know, you shall see it. You get all excited, don't you? You've got your annual card and they've taken
your little book. Pick them off in the book.
Exactly. That's right. And the book,
Okay, well, thank you so much, Pete. Thank you, everybody, for listening. Please do let me know any suggestions you have for future ones. Next week, my guest is Stuart Mullins from Clark's Legal. And I'm trying to remember what he's talking about. It's obviously what is it? Oh, very interesting. And coming up for recession, it's about guidance, legal guidance. If you're looking at snapping up some companies purchasing that are in a distressed position, what to particularly look for and how to do it in the best way. So that's going to be a very interesting one with Stuart next week. Anyway, have a lovely weekend. Good luck in the salsa. And
take care. Bye-bye.